The whole world awaits every quarter to hear about the Fed's decision on interest rates, the European Bank's decision, tracing interest rates across Australia, Japan, China, Europe, US, Canada, and whatnot. What do you believe? What is the effect of interest rates on the equity markets, on the commodity markets? While I agree it affects the bond markets, equity and commodity markets can be seen to be at their volatile best when these interest rate announcements are made. Most traders believe that there is an inverse correlation between interest rates and the equity and commodity markets. Rising interest rates are detrimental to profit and therefore to the performance, and therefore to stock prices too. And declining interest rates are met with cheer, with a strong belief that profitability will increase and there will be an upward movement in stock and commodity prices. Have you ever wondered the true fact? Nothing can be more untrue. Yet, we will hold on to our beliefs, even at the cost of losing our hard-earned money. It is our nature to cling to our beliefs. At the risk of survival, it's intrinsic to us. More about this later. For now, let's look at the facts. In the year 2000, during the dot-com boom, when markets were marching relentlessly ahead, the Fed rate was at a high of 6.25%. And then, the markets corrected, went through 9/11 attack, took a lot of beating. And what was the Fed doing? Lowering interest rates, all the way down to 1.13%. Did this change the trend of the market? Not at all. Markets changed the trend on their own. From 2003 to 2008, the upward march was on. And how did the Fed react? By increasing interest rates. For 17 quarters, they raised interest rates. But the relentless march of the markets was on. And in 2008, interest rates reached 5.75%. Rising interest rates lead to lower equity markets. Really? Or is this a fallacy promoted by vested interests? Hit pause and think for a minute. Welcome back. I will show you more. Now in 2008, markets started moving lower. And by the end of 2008, where did the interest rate stand? At 0.25%. And what were the markets doing? Heading lower and lower. Interesting? When we step back for a minute and see what is happening, interests do not appear to influence the markets, but it is the other way round. Markets influence the interest rates. We have got into the habit of putting the cart before the horse and expect our cart to move forward efficiently. The entire approach appears suicidal, to say the least. The fool and his money will be easily parted. Rising interest rates signal a healthy economy that can pay for the costs of doing business and are to be considered good for higher prices in the future. And lower interest rates only indicate that the markets are not conducive to growth and are most likely to be in a declining mode. Either ways, it is the markets that will determine the trend and the interest rates in the future, and not the other way round. Here, I present a comparison of CNX India Nifty with the Reserve Bank of India base interest rates. Don't get fooled by the pundits and the prophets. See for yourself.